right, everybody. So today I have a special guest, Adam Hynes. Not only is he a colleague, he's a good friend of mine, and we've been working together now for the last 3 years. And Adam has a great length of experience. He's also been in the industry 20 plus years. He definitely has a focus on investment properties and working with on commercial loans. He also does renovation loans, works with Island Advantage Realty for distressed homes, foreclosed homes. So we're going to talk a little bit about with Adam today and kind of go through some of the things that he specializes in. So thanks, Adam, for spending a few minutes with me today. I appreciate it. I guess one of the things that I'd love for you to share a little bit about is that relationship with Island Advantage and what it is that they do and how are you working with them to help promote those properties and get people into those properties.
All right, very good. Thanks, John. I appreciate you having me in your little TV series. It's awesome. So Island Advantage is unique because they have basically certain type of properties. They usually put me on the listings to approve the client because the property itself has to qualify for a loan, as you know. So when we do the appraisal, we don't want them to put a cost to cure on it. Mm-hmm. And for the audience, a cost to cure is, say, if there's no heating on or there's no kitchen or the roof is below the period that it's allowed, they're going to ask for a cure to be fixed prior to closing on a regular loan. And a regular loan is fine if you're dealing with a regular seller. But when you're dealing with a bank-owned property, they want it fixed prior to closing, which is a no-no. And that could put the down payment in jeopardy for the buyer.
Sure.
So we need to explain that to the buyer and make sure they understand they need to close with the property as is. And they don't hear that until we speak to them, Or if another loan officer is on the case, they could actually enter into contract, put a down payment down, wait 3 weeks, get an appraisal to come back, and now they have to fix the property that they don't own.
Right. Which who would want to ever do that?
No, exactly.
Right.
Who wants to spend money on a property that they don't own? So then we talk to them about renovation financing.
Yep.
And one good thing about CMG also is that we don't need searches. So sometimes we can get around certain things.
Mm-hmm.
But the renovation loan is one of those things that is, boom, it helps them get in the property and it helps them fix the property in one 30-year fixed loan.
Right. Yeah, it's a great solution for many, especially not, for those who don't have, an endless amount of cash. Here you're able to finance those home improvements into the transaction itself, and that's the benefit of the renovation loans. So that's great. But I think that there's a lot of content out there. Always promoting investment properties. How do you become an investor? How do you start that that chapter of your life? And I thought it would be good to talk a little bit about the programs that are used to buy that investment property, to start that business for yourself. So let's talk a little bit about the types of programs that are available for investors, because it goes beyond just the traditional lending experience where you're providing your W-2s and your pay stubs and your tax returns, and to be honest, most people struggle with being able to qualify for having multiple properties. So there are solutions for those people. So let's dive into a little bit about that, and maybe we could just start out with what non-QM is.
Yeah. So non-QM is basically non-qualified mortgage, so basically it's outside of the box. Mm-hmm. But an investor, when you first want to get in, it's a little tough in the beginning because a lot of the guys that do non-QM and the fix and flips, they look for experience. So they'll forego the income part. So you don't need income, you just need assets. So assets, experience, and credit are the basic 3 criterias.
Right.
So they look at the past 36 to 60 months of your track record, and they look for deeds. So if you're a silent partner, which I come across a lot of guys that go in and put money, but they're not on the transaction,
mm-hmm.
That's not counted as one of your transactions, So they look for deeds, CDs, or closing transactions from attorneys to show that you've purchased and sold a property, and that would be one. So you need 5 or 6 properties to go through in order to basically get some good transactions. Otherwise, you're up at 12, 13%.
Right.
And they want more money down. So they look at a transaction, and I know a lot of the viewers won't know what ARVs are, but ARVs, after renovated values, that means if you buy a property for $500, you put $50,000 into it, you're at $550 new purchase price. But then the bank wants to look at the after improved value. So if the value's 6 or 650, it's going to make a difference because they want 25% ARVs after the property's fixed. And that's to protect the investor,
of course,
and to protect the bank, at the same time.
Right.
So fix and flip, there's 3 criteria. You can go full income check, and you could do the renovation loan, home style it's called, or if you have no income, there's of course the fix and flips, and there's also hard money. And what hard money is just a private individual out there looking to invest, and they're looking to invest, make money in you,
right,
to help you. They want to make money with you on the property.
But the hard money is typically short term, maybe a year. They're
6 months, 12 months.
Yeah,
they want out in 12 months.
Right. And you're gonna pay a premium, obviously, in rate, and you're gonna pay some upfront fees.
Yep.
But it gets your foot in the door, and it allows you to close faster than it would be for let's say traditional financing. So now you talked about somebody having experience with owning and selling properties, but for the person that is just your everyday Joe and owns their one house and is thinking, I want to buy an investment property. So obviously we can look at a full documentation type of scenario where you can get traditional financing. They typically require a minimum of about 15% down, right, or greater. The more you put down, the better terms you're going to get, clearly. Right. But for somebody that doesn't show proper documentation, is there an opportunity for that investor that doesn't qualify through traditional methods?
They're just going to need more money down, and they're going to have to take a higher rate in the beginning,
right,
to show that they're basically ready to go. That's pretty much the honest answer.
Okay. And what kind of, so let's talk a little bit about the alternative, the non-QM alternative scenario. So you have your bank statement program.
Yep. The bank statement program is basically a program that will do look at your bank statements 12 to 24 months, and then basically take 50% of the deposits. So that's strictly for self-employed borrowers. So there's a bank statement program, there's an asset depletion program, and there's a P&L program. And a P&L program is a profit and loss program that basically will go off of your last 12 months. And then they want specifically 2 last bank statements to show you can match the deposits up. But they're strictly for self-employed borrowers, and the regular W-2 borrower has to qualify full income check.
Right.
So we can do primary residence and second home and investment in all 3, but the down payments differ with the credit scores.
Right.
The lower your credit scores, and I believe on investment 680 is the cutoff for investment. 660 is the cutoff for primary residence.
Got it. And what about DSCR? We talk about DSCR a lot.
Yeah, DSCR, debt service ratio, is basically a way that an investor, even a new investor, can buy a property, but the caveat is no repairs can be needed on that property. So the property has to be in average condition when the appraisal comes in, but it will go off just the rental income that is serviced by that property. So to give you a quick example, you're buying a property, $350,000, you put 20 to 25% down, 20 being the minimum. The mortgage payment cannot exceed the rental income. So if you get $3,500 a month for rental income, that's the maximum mortgage payment you can have.
Right.
In certain instances, you can go down to 75%, but the rate gets really high, and that hurts your qualifying.
Right. Yeah. The higher the rate, especially right now where the rates on traditional loans are in the 7s, and you may be looking what would you say, 200 basis points higher, maybe in the nines potentially on a DSCR loan?
DSCR, I just quoted 8.375.
Okay, that's good.
With 2 points.
Right.
So basically mid eights, that's a good deal, and that was 25% down. But
right.
if you put 20% down, you're going to be in low nines, high eights.
Right. So I would imagine though it's a lot harder to hit that, that 1-to-1 ratio when the rates are on the higher side.
It's getting higher, but harder. It's getting harder, but basically the challenge is the taxes as well, and you got to watch basically those rents, and not even watch the rents, because a lot of the times these guys can get the rents, but they got to remember when they're buying a one-family property, we could only use one rent. So a lot of the times the first question out of their mouths to me is, oh, but we could rent the downstairs and the upstairs and we can get $6,000 a month.
Right.
They don't do it that way. They do it off of an appraisal. Right. So they send an appraiser out to the property and they do a rental schedule and they see what the average rents are in the area. And for a one-family property, you can only use one rent. So it's one rent for a one family.
Right.
And that sometimes kills us.
Yeah, so that's a net operating income statement. And the issue too, remember, is that they're only going to use 75% of what they deem as market rent.
Well, in the DSCRs, they'll use 100%.
Oh, they will use 100%.
They'll use 100%. Yeah.
Right.
That's only if they're counting as income.
Right. So full documentation.
Correct.
Is that
75%?
Got it. Okay. And talk to me a little bit about, because you have some experience with some commercial, mixed use properties. We have an outlet for that as well.
Yep.
And just share a little bit about what is typically required in that type of loan.
Mixed use commercial is considered much different than residential. It's considered more on the property. So one big thing about mixed use is we want to make sure that basically, first we can go FHA. So we got to look at the percentage versus commercial versus residential.
Right.
And if it doesn't match, like 51% needs to be residential, 49% needs to be commercial. We could still do an FHA loan if it's owner occupied. But if it's not and it's strictly commercial, it primarily goes off of the property itself. So one red light to go off, if the property is vacant, it's going to be a problem. Okay? Most of the time you got to do hard money, get the property what's called up and running. So a bank looks at that property as a machine. Let's call it that. And the machine makes money. And if it's vacant or out of gas,
it's not making money.
It's not making money.
Right.
So they value that property much less. So they value a property off of the income that it makes. So if it's fully rented and operational and pumping out cash, you'll get less of a down payment.
Right.
Okay.
So they don't do something similar to what we were talking about before in terms of an evaluation. If it is vacant, then they can't use like market rent to do that.
Not on the commercial side. Only on the residential units, because the commercial side, what happens if you get a restaurant in there and they need to put in a kitchen and then they need permits and they need this? The tenant might not be operational for a good 6 months to a year if they need to do that. So the landlord needs to either make a deal with them. Maybe they do the renovations and they collect the rent. There's so many different caveats in commercial that basically they don't like to do that until basically they give them a sweet spot. You get a better rate, a better deal if it's operational.
So I guess the moral of the story is you secure the property using, non-traditional loan, like a hard money loan, and then you get it up and running, and then you revisit it and try to refinance the terms.
And in the cases where it's vacant, yes. In the cases that it's not vacant, and basically you're moving in and maybe you're a primary residence business owner. So you're buying this place to occupy one of the stores downstairs. In that case, then we could look at SBA financing and basically do up to 90 to 95% financing on commercial. So there's different caveats. It's looked at more logically than on the residential side. It's more of a business decision.
Yeah.
And you talk to a bank rep and basically you give them all the variables and
Right.
they come back and they kind of quote it. And the big, what they've been selling these days is an adjustable rate. There's no such thing as a 30-year fixed in the commercial side.
Right.
So basically you'll get a 30-year term, but maybe balloon in 20 years.
Right.
And it's like a 5-5-5 fixed.
For 5 years.
And what that means is, first 5 years, you're fixed. You adjust in the second 5 years, and you're fixed for another 5 years. And then in the third session, you adjust, and then you're fixed for another 5 years until you hit your 20-year term. Then whatever balance is left comes fully due.
Right.
Either they have to refinance it or they have to pay it off.
Right.
And statistically, the way it works in businesses, the first few years is always the toughest. But then when you start making money, you can make good money and start paying down the loan.
Right. So I absolutely love that. Thank you for sharing. And again, this goes back to, the flexibility of working with an independent mortgage banker opposed to, say, a retail lender where they're just focused on whatever programs they have within their four walls.
Yep.
We have the flexibility not only to do traditional financing, but we have that flexibility to do the hard stuff. Again, the non-QM stuff that we just spoke about, investors, we have so many different programs. We have the private label security program too, that's specific to CMG, where we're giving discounted rates on investment purchases, especially for traditional type financing, where we're avoiding the LLPAs.
Correct, and on second homes.
On second homes, yeah. So it's definitely giving us a little bit of a leg up there. But I definitely love this platform for lending because of the stability and the flexibility. If anybody has any commercial related questions, investment property questions, Adam Hynes, CMG, is a great resource for anybody. How does somebody reach out to you, Adam?
Best way to reach out to me is call me on my cell, 631-495-7716.
All right. I appreciate you doing this because I know he's not the biggest social media guy. We need to get him more on social media. And what is your email?
Hynes, and that's AHYNES at CMGHomeLoans.com.
Appreciate you, brother.
Thanks, John.
Thank you.
Appreciate it.
All right, you're welcome.